global markets might be heading toward a critical turning point. Japan's recent reduction in its holdings of U.S. Treasury bonds has set off alarm bells in Washington. The growing trade dispute, especially over electric vehicles, and new tariffs on Japan's auto industry have pushed Tokyo to respond in unexpected ways. Donald Trump appears confident, with Canada and others having conceded in past negotiations. But could this escalating economic tension lead to broader financial consequences? Market analysts are wary of making direct predictions, but one thing is clear: investors are tired of the back and forth. The uncertainty is weighing on global markets, and the Dow Jones has taken a hit for the second consecutive day. The Japanese Finance Ministry's statement on March 1, 2025, about diversifying investments was widely interpreted as a signal that Tokyo may further reduce its U.S. bond holdings. Washington reacted swiftly, with the U.S. Treasury Secretary urging Japan to avoid actions that could destabilize the dollar system. But is Japan's move a real threat to the U.S. economy, or is it a strategic maneuver to gain leverage? Japan has been one of the largest foreign buyers of U.S. Treasury bonds, holding billions in American public debt. Recently, however, speculation has grown that Japan might be trying to weaken the dollar through foreign exchange interventions. Tokyo has historically kept such actions limited to avoid U.S. backlash, but rising tariffs on electric vehicles and accusations of unfair competition may have prompted a shift in strategy. Behind closed doors, discussions have reportedly focused on the message: if the U.S. continues with its protectionist policies, Japan might reconsider its financial support. The U.S. Treasury Secretary publicly stated that trust between allies is crucial and that sudden moves by Japan could be risky. Meanwhile, headlines in the American press are raising concerns, with some warning that Japan's actions could undermine the dollar's global standing. At the core of this dispute is the electric vehicle sector, which has become a battleground for economic dominance. Japan is a leader in hybrid and electric car technology, with major brands like Toyota, Nissan, and Honda competing worldwide. As the U.S. seeks to boost domestic production, it has imposed protective tariffs that have frustrated Japanese manufacturers. Japan's finance minister responded strongly, warning that if economic interests are overshadowed by unilateral sanctions, financial instruments will be used in response. However, economists argue that selling U.S. Treasury bonds carries risks for Japan as well. A large-scale sale could cause market volatility and unexpectedly strengthen the yen, affecting Japan's export-driven economy. Meanwhile, the U.S. is pursuing protectionist policies similar to those of the Trump era, using tariffs as a tool to shield domestic industries. While Washington promotes green energy initiatives, it faces strong competition from Japan's advanced technology, leading to further trade friction. If Japan follows through with a significant bond sale, the repercussions could be substantial. Japan still holds hundreds of billions of dollars in U.S. bonds, and even a small sell-off could impact global markets. Speculation is growing over whether this could weaken the dollar's status as the world's reserve currency. The Bank of Japan has indicated that while it does not intend to destabilize financial markets, it will not allow itself to be disadvantaged in trade negotiations. Other Asian nations, including China and South Korea, are closely monitoring the situation. Chinese media outlets have described Japan's stance as unprecedented, while some experts predict that Japan's actions could lead to broader economic shifts in the region. While Washington will likely seek ways to ease tensions, domestic political pressures and business interests make it unlikely that the U.S. will fully back down. The yen has depreciated significantly against the dollar in recent years, influenced by Japan's low interest rate policies and foreign exchange interventions. Over the past 5 years, the dollar-yen exchange rate has climbed by about 15%. This depreciation has increased Japan's import costs and inflationary pressures. Meanwhile, rising U.S. interest rates have impacted global investment strategies, making it more difficult for Japan to manage its foreign exchange reserves. The yield on U.S. 10-year Treasury bonds reached 4.3% in late 2023, reducing Japan's return on investment and prompting a reassessment of its bond holdings. Beyond economics, the geopolitical implications of this dispute are significant. Japan and the U.S. have long-standing security and defense ties, but prolonged economic tensions could strain their alliance. A spokesperson for the U.S. Commerce Department emphasized that trade disputes between allies should be resolved through dialogue, suggesting that Washington is taking the issue seriously while avoiding a confrontational tone. Japanese automakers have invested heavily in innovative technologies, including hydrogen-powered and fully electric vehicles. Toyota, Nissan, and Honda are pushing the boundaries of battery technology, competing with American manufacturers. Japan argues that the US is blocking fair competition by imposing tariffs and incentives favoring domestic producers. Meanwhile, US automakers claim that Japan has its own protectionist policies. The dispute is fueled by mutual accusations, with Japan leveraging its financial position in an attempt to secure better trade terms. Some experts believe that Japan's actions are a bargaining tactic rather than an outright economic attack. If negotiations succeed, trade restrictions on electric vehicles could be lifted, and discussions of a new free trade agreement might begin. However, others argue that Tokyo is signaling a longer-term shift toward reducing its dependence on the dollar and strengthening its position in the Asian market. During a recent closed-door meeting with business leaders, Japan's Automobile Manufacturers Association urged the government to support the industry against U.S. trade barriers. In response, officials affirmed their commitment to leveraging Japan's financial influence in the global economy. Meanwhile, some U.S. senators have accused Japan of acting more like a rival than an ally, warning that its actions threaten American economic security. The Japanese press suggests that Washington may be forced to reconsider its stance, as the U.S. cannot afford to jeopardize its dollar-based financial system. However, continued tensions could destabilize global markets. If Japan, one of the largest foreign holders of U.S. debt, reduces its bond purchases, the U.S. may have to offer higher interest rates to attract new buyers, potentially fueling inflation and increasing recession risks. While Japan's economy remains resilient, it is not without vulnerabilities. The electric vehicle dispute is unlikely to be resolved quickly, as the U.S. remains committed to incentivizing domestic manufacturers. Japan, on the other hand, is adopting a more assertive approach, refusing to cede its leadership in innovation. The use of treasury bonds as a bargaining chip underscores the deep interdependence between these two economic giants. Market watchers are now focused on whether Japan will escalate its bond sales and how the U.S. will respond. Reports suggest that Tokyo may have tested the waters with an initial $10 billion bond sale, potentially signaling further action. If Washington does not ease tariffs, Japan could unload more bonds, leading to unpredictable market reactions. Some argue that this move could backfire on Japan, as a weaker dollar could reduce earnings for Japanese exporters. But with rising trade tensions, Japan may be willing to take that risk. This dispute could mark the beginning of a broader shift in global financial dynamics. Other countries, including China and Russia, have already reduced their U.S. bond holdings in recent years. If Japan continues down this path, it could spark renewed debates over the future of the dollar's dominance. Meanwhile, electric vehicle tariffs and trade restrictions will likely play a central role in shaping the next phase of this economic confrontation.